Hey, everybody, welcome back to another episode of A Millennial's Guide to Real Estate Investing podcast. Today, I am sitting down with Mike Zlotnik, who is a fund manager since 2009, and he also has his own podcast called Big Mike Fund, bigmikefund.com. Thanks for coming on the podcast today, Mike.
Antoine, thank you for having me.
No worries. So could you first start off a little bit about yourself and your family and how you got started in real estate investing?
Sure. I'm originally from, what used to be Soviet Union. So I go by as a Big Mike or Big Russian. But I left, it was still Soviet Union. It was that long ago, 1989 when I left. But I live in Brooklyn, New York. I've lived here for a long time with a family, married, 4 kids and a cat. And been doing real estate since 2000 and went full-time 2009 as a fund manager. And so that's my passion. That's a lot more fun than doing anything else. So
and what were you? What were you doing before real estate?
I had a executive career in the software development. Went through the ranks. So I've gone from rank and file to a VP, and director, and a few other things. And had a great successful career, but got burned out by that. So 2009, had an opportunity to do this full time, and it was a push, and just happened to take place, and never turned back. So software development is great, just in a different world. You don't have control, you don't have predictability. You can do very well in the business too. Just this is real estate is my choice rather than incidental type of thing. So
got it. And then what made you get into the lending aspect? So going from that background that you did have, what made you, and did you go right into lending, or were you an investor yourself before you started lending?
Yeah, so I invested in real estate passively starting from 2000, buying up properties in mostly New York, and by 2009 I had enough holdings and kind of enjoyed it so much. It was all passive, and you couldn't go wrong in New York. Everything appreciated here.
Yeah.
So but 2009, I was actually an investor into a venture started by my good old friend, and effectively he asked me to run that fund. So the fund was essentially doing transactional funding. I don't know if you remember those days, the days of transactional funding. So we did a whole bunch of that for a few years, and then it kind of naturally morphed into hard money lending, extended funding. So we went to that space. And we've been doing that for years, and then having experience in equity of deals and spending a lot of time looking into just traditional real estate transactions, I morphed into doing a lot of commercial deals with the same people. We've done lending, we've done value add, self-storage, value add, multifamily, value add, retail.
Got it.
So that's what happened, just a natural progression. But that sort of been the core. You kind of look at any deal. You could be in the capital stack. You can be an equity investor or a debt investor, and both have pluses and minuses.
Got it. Okay, cool. And then you started with transactional lending, and then are you guys still doing that today, or did you guys move more into other aspects?
We still do it rarely. One transaction every 2-3 months, no more.
Okay.
The frequency fallen off. The reason for this is transactional funding was very useful in the days of the short sales.
Okay.
And today, most people wholesale instead. So why pay a transactional fee when you can flip for an assignment fee per se?
Got it. Okay, cool. And then what are your thoughts then about the interest rates and the increasing interest rates? How do you think that's going to affect the real estate market, and is it going to affect your fund at all?
So interest rates are generally speaking are like gravity on real estate in general, again, because real estate is financed with leverage, and a higher cost of financing, high interest rates create less cash flow, and people are willing to pay less for those assets. It's just basics 101. But things different. What's interesting is certain parts of real estate actually appreciate with rising interest rates, and some components fall off. So luxury stuff where the affordability is worse. Has been beaten up recently.
Yeah.
And then the turnkey range, I think this is where you operate.
Yep.
The turnkey space. Turnkey space has seen an increased demand, even with high interest rates, because of the fact that there's a limited supply and there is an affordability shift down. So I think the interest rates are still climbing, and they're going to continue to climb, even though we've seen some level of slowdown. So Fed has been slowing down a little bit. But in general, they still need to make a few more moves up, and that'll put somewhat downwards pressure on real estate. What's interesting too is the fact that as rates rise, in theory, it's a result of either inflation or a way to slow down the inflation. So if inflation creeps up, then people should be able to afford to pay more for rental properties, more for any other real estate. So inflation may be the exciting part of the increasing interest rates. Does that make sense?
Yeah, that does. And then you're saying that there's going to be actually more inventory and more demand for the turnkey rentals because the A and B class neighborhoods are actually going to become too expensive for the homeowner because the interest rates are going to go up. So it's going to create, is that what you're saying? And then it's going to
It's already happening. Yeah, it's already happening. So if you look at any market, just think a little bit about this. So the turnkey properties typically Class C, but not necessarily Class C, some B minus.
Yep.
And these properties could be bought by first-time home buyer or could be bought by investors and then rented out. So these properties are generally just very affordable because they're not expensive, and affordability is good for folks who are making, I don't want to call it minimum wage, but any kind of reasonable blue-collar job, you can afford a $100,000 house. While the nice stuff, again, it depends on the market, right? If you're in California, I'm in New York, the cheap stuff costs here, $500,000.
Yeah.
But in most markets, let's just say an average property price is $250,000. So the stuff that's selling below 150 is very affordable and likely to do better. The expensive stuff, where the interest rates have impacted affordability, is what's losing demand. So people are shifting down. People who could afford $500,000 house now buying $400,000, and the $400,000 people are shifting down to $300,000. That affordability slide down is what's creating high demand for the turnkey range because there's really nothing cheaper than that.
Yeah, exactly. And that's how I answer the question that I get asked a lot by the potential turnkey buyers, like, oh, what do you think if the market slows down or if the market crashes, what's going to happen to these rental properties? And why should I buy now? I'm going to wait for the market to crash. And how is the market crashing going to affect my turnkey rental? And I say a very similar things. The people who are making minimum wage or working blue collar jobs are not going to get a pay cut. That it's actually going to be the A and B class properties that are going to decrease in value. The rents are going to go down. Everybody's going to be sliding down to the turnkey rental property space for them to live in or for even people to start buying them. So I answer that question too in a very similar way because everybody's going to be sliding down, whether that's the interest rates going up, inflation, or a market correction.
Yeah. It's sort of I don't want to call it great news, but it's certainly a good news for the affordable range.
Yeah.
The nice stuff is what's getting stuck. It's not selling, and people are not willing to pay the same price. It's down to the mortgage. It's what they can afford. The ultra high end is probably doing fine. I mean, because people buy that stuff with cash.
Yeah.
But the stuff that people buy on leverage is and with the high interest rates, it's been suffering a little bit. So.
Yep. I agree. And then that leads me into my next point. So do you think there is a correction coming? What sector do you think that correction is coming in?
So, I mean, we already seen some of the corrections in the technical correction in the stock market for sure. The real estate is a broad alternative investment space. So the stuff that's probably going to see correction is stuff that trades heavily dependent on interest rates. So leveraged investments, so multifamily in general, I believe is overpriced. As interest continue to climb, the cap rates will get somewhat higher, get worse, and the prices will come down. A number of other commercial deals might suffer. It really is a function of how much rates will go up.
Yeah.
There's also supply demand of the money in the general economy, right? If the economy does what it does normally, after a great expansion cycle, it'll have some kind of a contraction cycle. When that happens, the demand for some of these properties will come down. So I don't see any kind of a major global recession. I see spots of local corrections depending on the market. And give you some other examples of stuff that's already corrected and probably going to continue to correct. Condos, right? Condos get beaten up usually, especially like South Florida. Miami condos already taken a beating, and they're going to continue to take a beating because there's significant oversupply.
Yeah.
So,
yeah, that's true. Okay, awesome. And then, so your fund that you have, people can invest in your fund and invest with you. What's the difference between actually investing and buying a turnkey rental instead of investing in a fund like the one that you guys manage?
Sure. So they're very different kind of animals, and there's a beauty in each. When you combine individual asset, your strength is you have a property that you buy with leverage, you can get cheap debt financing, and you can own a turnkey, right? When you invest in a fund, you invest in a diversified portfolio. So one of the strengths of a fund investing, you take advantage of what we as fund managers do, our experience, our connections, our track record, and ability to find great deals. So fund creates an instant diversification. Also, generally speaking, fund has more liquidity than an individual deal. So if you buy a house and you want to cash out, you got to sell the house. Sometimes refinancing works. Yeah. When you invest in a fund, generally speaking, when you go past the lock-in period, you can redeem your units on a quarterly basis. Yeah. Other benefits are, with fund, you can reinvest distributions. With individual deals, you have to take the cash out off the table. Also, when you invest in a fund, you can add more money on an ongoing basis. Essentially, you reinvest distributions. You can add some money. You can take out some money. Yeah. With a property, you're stuck for a single life cycle, however long the holding period is. Yeah. So those are some basic benefits. Furthermore, from a return perspective, we do a little bit different things. If you buy a turnkey property, you typically bought a rehab property that is already in good shape, and you are just enjoying the cash flow and some level of appreciation. A lot of the projects we invest into are different. So we invest into a lot of hard money loans. Essentially, we lend money secured by real estate, and typically in first position. So we generate kind of a safer level of return, and our returns are generally higher because of the rates that we charge on hard money loans. So typically it's 3 points, 12% rate. On the other side of investing, we invest in value-add deals. So value-add deals, we force appreciation through innovation, development, redevelopment, and so forth. So we have plenty of projects. They're very different. I mean, if it's a self-storage redevelopment of an old Macy's, if you think about this, drastically different from buying a turnkey property. But the result of that redevelopment of an old Macy's to a self-storage might be significantly higher return than, does it make sense?
Yep. Yeah, it does. So, because you guys are going through the value add process, whereas if you were
exactly, we're going through the value add process. We're not trying to buy anything retail at all. Yeah. We want to sell to the retail buyers instead of, that's the key focus.
And do people who invest in your fund need to be accredited investors, or do you guys have a non-accredited?
Absolutely must be accredited. Okay. We operate under 506C, which requires verified accreditation. So if you are unaccredited investors, I appreciate your interest, but we can't help you.
And then what are you typically seeing for the returns for those people who invest in your fund?
Well, the target is 10 to 13% annually. Okay. There's some degree of fluctuations up and down. Our trailing 12 is above that level. But I would say that in today's market, where return expectations are coming down a little bit, even though we're running higher, I would still cautiously say that's the target range, 10 to 13. And some of it is coming as distribution, some of it is coming as appreciation. So there's some tax advantages as part of the investment because of the capital gains, and then we have depreciation schedules depending on individual assets.
Got it. Okay.
So that's
And then typically when you guys are giving your hard money loans to your clients, how long are those hard money? Are those 6-month or 12-month terms, or does it depend?
generally 6 months. We like short duration fix and flip projects. Occasionally we have longer projects.
Yeah.
We can renew 6 months into another 6 months.
Yeah.
But the core of what we like is short duration fix and flip projects.
Got it. And then are you guys getting nervous with the way the market is for the fix and flip market and slowing down your lending for those because there may be a market correction coming? Or how are you hedging against that?
That's a great question. What we do is we work with kind of an existing customer base.
Yeah.
We don't take all business from the street, period. In order for us to take any new referral, it has to be a referral chain. We need to know who the person is and the ability to manage problems, ability to solve issues, the integrity. So
Yeah.
we work with the same universe of folks, and that's a very consistent. We do a lot of finance on turnkey deals, fix and flips, and we like that range. So if we
Yeah.
have $65,000 loan on a $100,000 property, these things just don't go wrong.
Yeah.
They very few of these files have a problem.
Got it.
Where we do see issues, and we try to avoid them going forward, the high end stuff. Higher end has been beaten up, and we've had some challenges.
Yeah.
But we certainly going forward don't want to make any fresh investments in these nicer properties because of the risk associated with the market correction.
Okay, good. Yeah, because I live in Los Angeles, and there's a lot of people here who are flipping. And I'm like, I don't know how you guys are still buying deals. I would be scared as hell to buy anything that, that's going to be a 6 or 12-month long project that is, ARV of $1.5 million. It's like there doesn't need to be much of a market correction for that ARV to slide way down to 1.2, and there goes your profit. So I don't know how these people are doing it.
Yeah, what we know it's interesting. We have some amount of good old clients from California. We continue to do files with them, and we do scrutinize these values. It depends on where. It depends big time where it is. If it's in Silicon Valley, ultra hot location, there's some correction, but ultimately where are the jobs? And correction is happening in the areas of secondary homes, vacation homes a lot faster than. If an area has an average property with an ARV of $2 million, and the house is an average in a given area, the correction is not. We're not foreseeing any big correction. Just off the top of my head, the deals are tight. So I've advised folks a number of times. The same feedback. You're buying it. Purchase and rehab is 82% of ARV. If you're off by 10%, there's your whole profit and you're turning negative. Yeah. So it's just tight. It's absolutely tight. And California deals need an extra degree of care. And just we work only with a very few really good people. Beyond that, you're right. It's totally right. It's just too tight.
Yep. Exactly. And what is for people who are going to go and invest on their own, what's your best real estate investment advice for people who are going to go and do it themselves? So I know you already spoke about working with the right people. I do the very same thing where I focus on working with a very small amount of people. If one person does me in the right way, then I keep working with that same person over and over and over again. But what's your best real estate investment advice if somebody's going to go and do it on their own?
Invest in what you understand. That's a general advice. So if you understand single-family turnkey properties, keep doing what works. Yeah. If you're trying to get into some kind of multifamily self-storage, find a good co-investor, co-sponsor, somebody you could trust and learn from. So if you have money and you want to get some experience in a given field, I would say that you need to find kind of a co-sponsor, co-investor. Other than that, you could take some level of educational classes. So you will go into basics. Ultimately, we see this every day. So somebody's coming forward with a multifamily project. Literally, it's their first deal. And my advice is find a co-sponsor. Find a co-sponsor. If you can't find a co-sponsor, we can potentially help you find a co-sponsor.
Yeah.
Because you need that experience.
Yeah.
You basically have experienced partners, credit partners, money partners, right? If you are the money partner, you have the money, you need the credit partner and the experienced partner.
Got it. So, yeah, no, I completely agree. There's a ton of people here in Los Angeles too who are trying to invest in multifamily out of state, and they've never bought anything out of state. And I advise them all the time to just start small. And yeah, finding somebody to sponsor you is a good idea too. But those people are super hard to find, in my opinion. So I've told people just start small too. And if your goal is to get into multifamily out of state, there's nothing wrong with starting with single families, then buy a duplex, then buy a 4-unit, then buy a 16-unit, and slowly scale up. Because that's what I've done personally, is built my team from the ground up with the single family, then using those people to buy the apartment buildings later on. But yeah, I think that's good advice.
Yeah, just a quick comment on this. It's a little bit of a different universe doing sort of 1 to 4s versus larger multifamily. Yeah. So multifamily is economy of scale. Like anything below 70 units gets hard to manage remotely. You need on-site management. So that's why they say 70 units is the magic number. I mean, there's no simple answer to the question, right? Yeah. You investing out of state, especially in an unknown area with unknown people, is a very high degree of risk by itself. Yep. So build some relationships first with people who you know, like, and trust, and maybe co-invest. That's the way to go out of town. Otherwise, you could screw up these projects 5 different ways. Yep. We invest a lot of these syndicated deals, but there's so many terrible syndications out there. I mean, I've looked, I continue to look at number of deals and sponsors, and so much garbage out there. Yeah. Because investors are hungry. They want to put the money to work. Yeah. So be extremely careful investing with strangers. Yep. Put it this way.
Absolutely. So how does somebody get in touch with you? What's the best way for people to reach out if they have more questions or want to do some business with you?
Sure. So again, it's a very easy website to remember, bigmikefund.com. That'll take you to the podcast, but it's our primary website, and you can navigate. You could reach out through email info at tempofunding.com. That's our primary website, tempofunding.com. And ideally, if you want to chat, try to come up with a referral. How did you hear? How did you get a hold of? I very much follow referral chains, so okay. I need to know who referred you. But bigmikefund.com, if you mistype it and you type in bigmikefund.com, it's not a kinky site. We'll wind up in the same place.
Awesome. Thanks for coming on the show, Mike. And I think there's a lot of value here that people can take away.
Thank you, Antoine. Appreciate the opportunity to be.
Bye.
Take care, boy.